Well, hi there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, here on Thursday, October 23rd, 2025. Thanks for joining me today. We're coming to you from a beautiful fall day here in Redmond, Washington. Kind of cool, not too damp. Uh, Wonderful day. By the way, if you've picked up on my voice subtly getting lower in register as the week goes on, I joined the Seattle Symphony Chorale this season, which is super exciting. I've sung in choirs as far back as I can remember. Sang with the Cleveland Orchestra Chorus when we lived there, and just got around to auditioning for and now joining the Seattle Symphony Chorale. We're performing the Vaughan Williams Sea Symphony tonight at Benaroya Hall in Seattle. So any of you in the Seattle area that want to hear an awesome concert with one of the most probably underappreciated and underperformed great choral orchestral works. We're performing it Thursday and Saturday here, but I sing bass too, and I'm belting out a lot of low notes. And so my voice is kind of steadily declining as the week goes on because we're, rehearsing every evening. But super excited to be performing. And again, hope some of you can attend here in Seattle. That would be awesome. Market actually hanging in there pretty well today, right? And a nice upside follow through day with the S&P up just over 0.5%. Mid caps and small caps even better. Oil prices accelerating to the upside. Energy stocks starting to work. Breath not looking too bad. A lot of things to be kind of excited about here. I would argue the market's still very much in a transition. No real clear sense of whether this is just the next big leg higher or a continued kind of, choppy sideways corrective move, and we just have a brief pause. We'll have to see which way the market resolves, but let's do our best to break down the signals in the market here today. As a reminder, appreciate you tuning into our show every weekday after the close. We are getting away from live broadcasts this week and doing more recorded episodes just to sort of change the format a little bit and think about some different ways to incorporate live Q&A into other parts of what we're offering. So I appreciate you hanging in there. Appreciate your feedback for sure. But as always, very much appreciate your questions. We're going to do a mailbag episode on Friday. We'd love to answer one of your questions as part of that episode. All right, so here's what happened on Thursday, October 23rd. The S&P finishing higher 0.6%. You can see the major equity averages here on the front page of the dashboard on stockcharts.com, looking pretty green. The NASDAQ composite even better, up 0.9%. Mid caps, small caps, all up. The S&P 400 mid cap index up 1.4%. That's your top performer. So some of the smaller mid cap kind of names doing even better. This was not a large over small kind of day, but actually a small over large kind of day. Turns out we can have some of those. The VIX spiked briefly over 21, or up to 21, I should say, spiked briefly over 20 yesterday as a, sort of a brief red flag waving after lunch. Today, though, the VIX generally declining as stocks rallied. So the VIX finished today just above 17, which again, by my read, low volatility environment, that's encouraging. The more that the VIX remains below 20, I think the more confident you can be in the fact that this is a continuation of the uptrend that we've experienced off of the April lows. Keep an eye on that VIX chart, though, as always. 10-year Treasury yield moving slightly higher today, still below 4%, right around 3.99. The long bond yield's just below 4.6%. 5-year point around 3.6%. Next Fed meeting coming up next week, and that's where the market essentially pricing in pretty much a 100% chance that the Fed lowers rates 25 basis points. There will, as always, be plenty of speculation about what will come at the December meeting and now the beginning of 2026. And those first couple meetings there, market pricing in continuing lower of rates into the new year. But we'll see what happens. The Fed meeting next week should be an opportunity to get an updated, what we call the dot plot, which is where the individual Fed governors are, projecting interest rate policy going forward. So certainly we'll be ready. We'll be ready for that, and we'll cover that the best we can. Dollar flat for the day. Bond prices slightly lower. Looking at the commodity space, gold and silver having a nice recovery after getting beaten down earlier this week. GLD up 0.4%, silver up 0.7%. So for now, right, charts like gold and silver appear to have experienced a sudden and severe pullback after making their latest new all-time high. GLD pushing above $400 a share for the first time since its listing. Pulled back suddenly earlier this week, now kind of recovering a little bit. Sold off going into the close, but overall kind of a nice recovery after that sell-off earlier. Crude oil prices, though, the big story, right? The evolution of the events in the with Russia and sort of the whole international trade debates and discussion, and the potential for conflicts to continue to evolve, putting some upside pressure on crude oil prices. We see the USO up another 3.8% today. Energy ended up being the top performing sector in the S&P. A lot of energy stocks looking pretty encouraging here. We actually did a video, actually an article for stockcharts.com just this afternoon looking at Apache, APA, and that kind of nice uptrend channel and this latest upswing in crude oil prices causing charts in the energy sector to have a nice upside gap as well. Looking pretty constructive here. And that, I think the bullish case for those stocks involves stronger oil prices. That's certainly what we're seeing here this week. Bitcoin, Ethereum, the rest of the top 10 cryptocurrencies all up today. Bitcoin did briefly get above 111,000. It's currently trading just below 110,000. But for now, I like the fact that charts like Bitcoin are holding key support. For Bitcoin, it's around 104 to 105,000 based on a number of different technical disciplines. We've been sharing that chart recently on the show. But for now, holding in there pretty well. And I like the fact that we're getting a bounce off of that potential area of support. All right, looking at the 11 S&P sectors, you can see 4 down, 7 up. The energy sector, the XLE, at the top of the list. Do not adjust your monitors. Do not adjust the stream. That's what happened. Energy outperforming tech and all the other sectors as well, up 1 1/3%. Tech wasn't far behind, though. Industrials and materials as well, all up about 1 1/4% today. So it was tech, and then the MEI trade, materials, energy, industrials. Those are often grouped together, at least in my thinking, this sort of the cyclical sectors, sectors that tend to be kind of economically sensitive, and doing quite well here. Stronger crude oil prices, part of the story. Stronger commodity prices elsewhere, helping with some of those for sure. On the downside, 4 of the S&P sectors finished in the red, including 3 of the most defensive sectors. Consumer staples at the bottom of the list, down 0.5%. Communication services, not very defensive, more of a growth sector, but still down about 1/3%. Utilities, real estate, healthcare, essentially flat for the day today. All right, looking at the breadth, not too bad, right? I mean, on the S&P itself, a little more neutral, but overall, these are pretty decent breadth numbers, right? About a 2-to-1 ratio on the New York Stock Exchange, 64% up, 34% down. That's a nice kind of positive reading. And so overall, I would say that's pretty encouraging. Looking at the Magnificent Seven and Friends, these leading growth stocks, Tesla actually managing to close higher today. Tesla had earnings yesterday, traded lower in the after hours, opened weaker, but ended up closing back up toward 450. I think that's a really encouraging sign because in one day, if you look at the little preview chart that I'm showing there, Tesla basically, opened down toward the lows of this range and then traded back to close around 450. That's the highs that we've experienced this week. So at the open, it looked like Tesla was going to be a very negative post-earnings story. But this is why we actually watch what the price is doing, because what we saw from a technical perspective is accumulation, right? We saw demand coming in and Tesla closing back toward the highs today. Still not a great breakout chart, right? Still not making new 3-month highs, which for me is sort of that signal that we're in a period of accumulation, but snatching victory from the jaws of defeat, very much how I would describe today's post-earnings reaction for Tesla. Amazon up 1.4%. Broadcom holding in up about 1.2%. On the downside, Netflix gapped lower yesterday, got crushed on earnings, and opened and closed lower. Today ended up drifting a little bit lower. It was a lot worse earlier in the day as it traded as low as $1,100 a share. But Netflix still down about 0.25%. Microsoft, Meta, we'll call them flat for the day today. All right, let's look at the heat map. This is one of my favorite types of visualizations where we can look macro to micro. I like areas of my process where I can start big and go small, where I can understand the overall forest. I can then look at a tree. I can then look at a branch, then look at a leaf, then look at the veins on the leaf. That is the wonderful metaphor, I would argue, for a good macro to micro investment process. And I'm not saying that order is necessarily what's most important, but generally speaking, going from big to small, from macro to micro, for me, has been quite helpful, right? And then when you're analyzing one particular stock, you can think about the forest for the trees, as it were. You can think about how the broader, macroeconomic forces might be related to that particular story at this particular time. So what stands out to you as you're looking at the heat map? For me, it's actually quite a bit of variety. And it's almost by sector, right? Some sectors obviously did quite well today. Energy in the bottom right stands out. Industrials in the upper right stands out. Technology in the upper left. Those are the three sectors that really stand out as having some pretty broad advances today, where there's a lot more things working than not working. Within the technology sector in particular, I would highlight today, you had a nice upside reaction on a lot of semiconductor names. We highlighted earlier this week how charts like Micron and others, Lam Research, KLAC, Monolithic Power, some charts that have been pretty good have pulled back a bit. We're seeing a lot of those actually rotate higher today, which I would argue is pretty encouraging, right? A strong bull market needs to have leadership. A strong bull market, a healthy bull market phase, needs to have an expansion in new 52-week highs, which means you need KLAC and other leading growth names to resume their uptrend. What did not look good earlier in the month of October is charts like KLAC making new highs and then pulling back, right? And seeing that initial sell-off. And then the question is, how much of a correction is it? Is it a time correction? Is it a price correction? Is it both? How long, how far, how deep? Those are the questions you have to kind of, think through and just sort of understand the risk to reward. But when KLAC finds support at 1,000 and then resumes the uptrend, making a new 52-week high today, I think that's a pretty encouraging sign. So I'm very encouraged by the strength that you see in a lot of the technology stocks. I would argue charts like Seagate, Western Digital, sort of the hard drive names, the storage names, still much more to prove. But early leadership starting to show signs of strength, which is encouraging. Within the industrial sector, we've talked about names like GE Aerospace, Eaton Corp, that either have experienced bearish divergences. In the case of GE, just lower highs. In the case of Eaton, the way that this resolves in a positive way is if those names resume their uptrends and make new highs on stronger momentum. That's kind of the ideal outcome. If you're all bulled up and looking for confirmation, that's what I would need to see. Again, day like today, pretty encouraging, particularly in the aerospace defense space. How Met Aerospace stands out, up almost 5% today, closing above $200 a share, new 52-week high. I think those are encouraging charts. We've been covering the strength in aerospace and defense all through, really off of the April lows as that's continued higher, and I would say that trade very much in good shape here. Final thing I would note would be the strength in energy, right? I mean, energy, not a great area until and unless crude oil prices go stronger, right? Because the weakness in the energy sector, in no small part, is because of the weakness in crude oil prices, right? I mean, this is a group of stocks, again, with some differing businesses, but generally speaking, they are tied to the price of crude oil. So if crude oil does well, these stocks are probably going to benefit because they either are getting oil out of the ground or getting oil out to the gas station or helping you pump it or whatever their business is. Now, there's renewable energy and other things in there too, of course, depending on how you bucket those and other areas of energy production. But a lot of these stocks are really driven by crude oil prices. And I would say the rally in crude oil prices we're experiencing this week is part of the reason why charts like Halliburton start to look pretty encouraging as they gap higher on earnings and continue higher. Charts like APA, which we highlighted and just mentioned earlier in the episode, a nice uptrend channel today, gapping higher after testing support at the 50-day moving average. So if we're going to keep seeing stronger oil prices, I think charts in the energy sector start to look pretty encouraging. The energy sector, the XLE, is starting to outperform. And so I would say, again, general plain vanilla analysis, the basic assumption I need to make to determine whether a chart is constructive. Are we in an uptrend? Are we in a period of accumulation? Are we making higher highs and higher lows? And that's what I'll be looking for on some of those energy names. Not all of them are great charts yet, to be clear, but the stronger we see crude oil prices, the more that they're going to start to look the part. You know, in terms of downside, not a lot to talk about, but I would tell you the mobile names, kind of the old school telecoms. I'm looking at you, AT&T, Verizon, T-Mobile, all pretty rough here. And I would say AT&T has gone from being a fantastically strong chart, going into September, has become a very weak chart. This is probably a good opportunity to just talk about like what makes a chart go from being a really encouraging chart to a really not encouraging chart. I think AT&T has all the ingredients for this recipe. Let's talk about how things looked in early September, right? When I say a chart's a good chart, what makes it a good chart? I would say making new price highs, breaking above resistance, the moving averages in the proper order, meaning the price above the 21-day EMA, which is above the 50-day simple moving average, which is above the 200-day simple moving average, and they're all sloping higher. The momentum strong, the RSI getting above 70 on upswings, the relative strength improving. Mid-August, it's about as strong of a chart as you're going to find. Now, go to mid-September. How did the picture change? Well, starting at the bottom, the relative strength no longer going up. The relative strength is actually slightly lower. The momentum, instead of making new highs, being overbought as the price goes up, the RSI is actually sloping downwards. Really not making aggressive new highs, but more stalling out at the previous tests. And then eventually we start to fail to hold moving average support. And that's what got the chart of AT&T going into October. Now let's go forward another month, and we can see how I would argue we transitioned from an accumulation phase to really a brief consolidation phase, or at least signs of the end of an accumulation phase, into a clear distribution phase. What puts us in a distribution phase? Moving averages starting to slope downwards. Moving averages not holding support. We broke the 21-day EMA. We broke the 50-day. Now we've actually broken the 200-day. Now we've tested it from below, and we've failed to get back above it. The RSI, which had a divergence, now going lower. And instead of holding 40, which is often a really encouraging sign of additional demand on short-term weakness, that's not there. And so we see the price going lower as buyers are nowhere to be found. And all of that price weakness and the weaker momentum causes the relative strength to go lower. So if you want to take a snapshot of an example of a chart that's rotated from an accumulation phase to a distribution phase, I think AT&T over the last 3 months, perfect example, textbook example of that. What does that mean? Well, I would say your goal as an investor, and certainly my goal as a technical analyst, is to navigate this kind of period and to recognize when a stock is showing strength, to think about what that end of that move might look like, that exhaustion sign, which is why we often highlight divergences, because that's one of those early warnings that these new highs may not be trusted or should not be trusted. And then recognizing when we have breakdowns. This is why I often scan for stocks making new swing lows, breaking below moving averages, because I want to identify here before it gets all the way down to 2450. I want to know at 28 that the stock's starting to fail to hold support in a way that speaks to a weaker trend. So kind of a great example of a rotation in trend there with AT&T. All right, let's finish off looking at some charts. As a reminder, I love your questions. I appreciate them so much. Please keep them coming. Use our YouTube channel. Drop comments with any questions that come up as you're watching the show. We're planning an all mailbag episode on Friday. We'd love to answer one of your questions on the air. By the way, special thank you to our partners, helping us put the show on every day. Today, I want to thank Koifin. If you go to marketmisbehavior.com/Koifin, you can learn about the fantastic product, which I've used, daily for a long, long time, for many moons. I use Koifin as a great sort of top-down perspective on the markets. I use it especially for international stocks because some of the platforms I use are not as deep in the international space. Koifin has all the international data. So when I've done some events for investors in Italy, and I wanted to dig into some of the larger Italian stocks or Indian stocks or some other market that I'm less familiar with, I'm able to look at some of the big constituents using Koifin and really break down some of those charts using the universal language of technical analysis. I use it often for ETF holdings. If I'm looking at something like the QQQ or NLR, which is a nuclear ETF that I currently own, I'll bring up the holdings on Koyfin to dig a little deeper and understand the performance, understand the weightings, and make sure that I do that as part of my due diligence before I would add an ETF to my portfolio. I would encourage you to check them out. Marketmisbehavior.com/Koyfin. If you use my link, you get a little better deal than if you just go back to their directly to their website, and helps me make Market Misbehavior awesome. So I appreciate you checking them out. All right, let's look at some charts here. Here's the daily chart of the S&P 500. No change to the general thesis we've been talking about. This is a market in a primary uptrend, and I say that with confidence because we keep making higher highs and higher lows. At some point, that will no longer happen. And the most concerning is if we fail to make a higher low, which is why S&P 6550 for me remains my line in the sand for now. We remain safely almost 200 points above that support level. So for now, my line in the sand is safe. I think this market's still in an uptrend. Innocent until proven guilty. The momentum right now, pretty decent. We did get a bit of a divergence here going into the early October high, which is why we're on sort of breakdown alert and correction alert. The correction for now has been fairly short-lived, and 6550 held a couple weeks ago. At some point, if that would not hold, you will hear my tone and general discussion get a little darker and a little less optimistic, because that would represent a breakdown in price, which we've not seen since the April low. Let's talk briefly about sentiment. A lot of the sentiment, particularly the survey data that we follow, comes out on Thursday. It's usually updated through Wednesday, and then is reported out to vendors and market data providers on Thursday, which is why this is a good day to sort of review that. The AAII survey taking a bit of a bullish turn. Last week, we highlighted the fact that bullish respondents had come down quite a bit and bears had increased quite a bit, making the survey net negative for the first time in a month. This week, still net negative, but a few less bears, a few more bulls. So a little more optimism coming into this week. Bears still outnumbering bulls by about 6%. I think if that survey would get back net positive, that would actually be a pretty encouraging sign here for optimism and strength going into year end. For now, we're wait and see mode. You know, interesting to me, if we do get a broad recovery from here, if Q4 ends up being remarkably strong and we never get that correction that many of us have been looking for just because of the length of the run that we've experienced to date, and valuation concerns and all the other things that we've certainly covered, the weaker breadth and momentum, if we would continue to go higher, one of the things I think I will look back on at the end of the year and think about what I learned is the name exposure index remaining fairly constructive all through September and October. It never got that negative, right? I mean, since July, that's the last time it's been below 80% allocation. This is a weekly survey of money managers asking their allocation to equity. So this is a percentage that respondents in that poll are allocated to the equity markets. This week, up again from around 85% to just over 90%. So money managers in this poll actually stepping on the accelerator a little bit, following this trend higher, showing quite a bit of optimism. All right, crude oil prices are turning higher. This is my daily chart of the crude oil future. We highlighted yesterday the fact that we've often hit resistance around the 38.2 to 50% retracement. We've done some work on that over the last couple of years. It's happened more often than it has not. Doesn't appear to be holding here this week because crude oil gapped up again today, finished the day around $62 a barrel. That's up quite a bit from 56 and change, which we were at just a couple sessions ago. So we're seeing a huge spike in crude oil. It's obviously driven by geopolitical events and threats to global trade and all the things that we've been talking about. But today's rally appears to generate a MACD buy signal. It's not often you get the MACD indicator this low generating a buy signal. There can be false signals like we saw here in April before we retested the low. But generally speaking, that's a sign of increased demand. That's a sign that the short-term trend appears to be turning higher. Now, the strength in crude oil is still a lot to prove. Right? We're still below the 50-day, still below the 200-day. But it's meaning things like the oil services ETF. This is the VanEck Oil Services ETF, ticker OIH, making a new 3-month high today. I often scan for charts making new 3-month highs just to make sure that I'm aware of and recognize areas of the market showing new strength in particular, right? Stocks and ETFs breaking out of bases, breaking above resistance, representing additional demand. Look at what's happened on the chart of the OIH. We broke out above the 200-day at the end of August. We pulled back and tested the 200-day about a week and a half ago. we have now rotated higher. The moving averages are all in the proper order. The RSI is pushing above 60 this week, which is arguably the most important thing. So OIH above 270, a nice breakout up over 5% today. Would love to see some follow through going into the weekend, which would validate that breakout. Tell you what's not breaking out: Netflix. After disappointing earnings earlier this week, the stock was down about 10% yesterday, testing the 200-day moving average. Today, traded briefly below the 200-day. It did close almost exactly, I'm talking to the penny, at the 200-day moving average today on Thursday, October 23rd. If that can't hold, this is a very disappointing chart in a clear distribution phase, but it's still an open question because we still held it on a closing basis. I really wouldn't get excited about this chart until it got above 1250, which would finally clear the August, September, and October highs. But as more of a swing trade, betting on a bounce off of the 200-day to retest those levels, or at least test the 50-day moving average, I think makes a lot of sense. But we don't hold the 200-day, I would argue all bets are off. That's showing a period of weakness. What you want to see with Netflix is what we're seeing right now this week with Amazon. Last week, Amazon tested the 200-day moving average. This week, gapping higher, trading higher. Again today, up about 1.4%. Still more to prove. Still would like to see it get above the 50-day moving average, which is where it failed earlier this month. But overall, encouraging that it's not broken below the August lows or the 200-day moving average. By the way, Amazon and some other big time mega cap Mag 7 kind of growth names are all reporting earnings next week. Amazon, I believe, next Thursday. All right, so what's actually breaking out? A couple examples for you. CrowdStrike. We highlighted in our, looking at the heat map, how some technology names were looking quite good. CrowdStrike up over 4% today, making a new all-time closing high, closing above 521 for the first time. If we can follow through, that's a brief pullback to the 21-day EMA and then a break to new highs. Now we have a divergence, which is why I think this is super important to watch here. Stronger price action on stronger momentum would be a really bullish outcome for CrowdStrike after consolidating for the last 3 months. Keep an eye on that one. Insight is a biotechnology name. I wrote an article earlier today for CNBC Pro. So if you follow my work over there, you can look for a couple more charts really sort of laying out the case for Insight. But I'm noting the similarities with what we're seeing right now versus what we saw at the end of July. We had what ended up being more of a time correction, right? The markets can correct in one of two ways. It can correct in terms of price, which means we pull back, or it can correct in terms of time, which means you don't pull back. We just sort of hold water for a little while. Call that a time correction. And what you look for is that consolidation eventually ends and we break out. This is what it looks like in June and July. We sort of stalled out here around $71 a share before finally breaking out at the end of July. And that signaled a move to new highs, which we ended up getting. August, September, now October, kind of a similar pattern. Time correction, hitting the 50-day, breaking out. Time correction, hitting the 50-day, breaking out. Question mark. Overall, I'm encouraged by what I'm seeing. I like the stronger momentum. Stronger volume would validate that a little bit more. Finally, have to highlight the strength in aerospace. We highlighted charts like Howmet, HWM earlier doing quite well. Raytheon is a stock gapping higher on earnings and continuing higher. It's called that the gap and run pattern. When you have a gap higher and then we continue to see demand. A gap and fail pattern is pretty negative, right? If we gap higher on earnings and then rotate lower, that suggests everyone's thrilled to cash out on that gap higher and has no interest in owning any more of Raytheon. But what you're seeing on the chart of ITX, the gap and run, gapping higher, additional buyers willing to pay more, and that is propelling the stock to higher highs and higher lows, onward and ever upward, as it were. Folks, that'll do it for today. Thanks so much for joining me here on Chart This with Dave Keller. Please take a moment, like the video if you wouldn't mind. If you're not subscribed to our YouTube channel, what better moment than right now to do so? But please leave a question. Let me know what questions you're coming up with as I share the charts today. Any tickers I didn't show that you wish I had, drop a comment below and let me know. Maybe we'll feature your question in our mailbag episode on Friday. For now, I'll say have an enjoyable Thursday evening. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.